So there have been a number of references already today to the Fed and to interest rates, and that's not surprising given the really central role that the Fed is playing these days in trying to control and govern the U.S. economy. What I'm going to talk about today is a particular topic involving the Fed, and that is the relationship between Fed policy and house prices. So to begin the story, we have to go back a number of years, back before the onset of the 2007 financial crisis, and ask what the Fed's view about the role of house prices in their policymaking was at that point. And then, as I go through the talk, we'll roll the time forward to today and see what's changed. So the first point is that when the Fed was thinking about how it would make policy, monetary policy, before 2007, it was focused intently on its dual mandate, which is to provide low and stable inflation and full employment. Financial stability issues, including house price appreciation, whether that was causing bubbles and the implications for the financial system, they were really very much a lesser concern at that point. In setting monetary policy, the Fed did take account of the effects of house prices on growth and inflation, primarily by trying to estimate how much the additional housing wealth would increase consumer spending and how much the high house prices would increase construction activity. There were a lot of discussions as well, I took part in some of these discussions, about whether we were in a housing bubble, whether housing was really overvalued. But the conclusion from all those discussions was that the Fed decided it was not going to try to lean against a house price bubble, even though there were some concerns, significant concerns about overvaluation. So why is that? I think it's the result of really three key assumptions that Fed policymakers were making at that time. The first is that bubbles are hard to identify as they're building. And that's particularly true for the relatively early stage of a bubble in any market. And it's particularly true, I think, early on because virtually all bubbles are initially rooted in real improvements in fundamentals in that market. So take the internet stock bubble that burst in the late 1990s. Well, that reflected a period in which stock prices got ahead of fundamentals, but there really was a boom in that sector of the economy that generated very robust expectations. It just got taken too far. Second, even if a bubble could be identified, the appropriate Fed policy response to the bubble is really not clear at all. There's essentially no guidance in the economic literature about what a central bank should do. And the goal, if the Fed were to try to lean against the bubble, would be to deflate it very gradually so as to not generate disruptions in the economy. But they don't know whether deflating it gradually means raising the federal funds rate 50 basis points, 100 basis points, 200 basis points, 500 basis points. It's just a complete unknown. The third assumption is that if the bubble were to burst, the Fed could just ease policy after the fact to prevent financial instability. So what that meant was that they didn't have to be too concerned about taking preemptive action to try to deflate the bubble because they felt that if one were to develop and then to burst, they could come in, dramatically lower the federal funds rate, ease policy, and clean up the mess after the fact. I mean, it didn't work out that way, but this was their thinking at the time. I think the final deterrent was a real concern that explicit attempts to lean against asset values could be very, very unpopular. I mean, they got a taste of that from the comments that former Chairman Alan Greenspan made in 1996 about irrational exuberance related to stock prices. These comments were not really a comment at that point about whether stock prices really were overvalued. He was just kind of speculating. They were really very tame, loose comments. But I mean, I can recall conversations with people in the financial markets shortly after those comments, and the reaction was not good. It was basically, why is that guy talking about things that can cost me a lot of money? He should keep his nose out of trying to predict where stock prices are going to go. So I think that really has weighed on the Fed's view about whether it should be actively involved in talking about asset prices. So now let's roll the clock forward to today and ask, looking backward, what does the Fed think its role was in terms of boosting house prices? And I would say that the general view of the Fed is that the evidence that they can see cuts against monetary policy having had a major role. They would fully accept that the low interest rates in the 2002 to 2006 period played some role in boosting house prices. But they would push back very hard against the view that it was the prime culprit, and that if only they had set the funds rate a few hundred basis points higher, we never would have had any of this. That they absolutely reject. So why is that? There are three reasons. The first is that house prices were rising rapidly before policy was eased after the 2001 recession. I have a slide that I'll get to in a moment to illustrate that, but I'd just like to go through the list of points first. The second is that the increase in house prices was too large, way too large, to be explained by the decline in interest rates. And the third is that if you look at the evidence internationally, the relationship between the stance of monetary policy across a number of countries and house price increases is not tight. So in particular, there were many countries that had house price booms, many of which were larger than what we had in the United States. In some of those countries, monetary policy was actually quite loose, as judged by a standard metric called the Taylor Rule, which tries to assess whether central banks are setting policy in a way that's consistent with their inflation and employment goals. So Ireland and Spain would fall in that group. But on the other hand, there were countries like the UK and New Zealand and Sweden that also had very large house price booms where policy was judged to be exactly right. So I think the Fed views the fact that those inconsistencies are there means that the international evidence is really quite ambiguous. So let's go back to the first point about house prices, what they were doing when the Fed was easing. So you can see that the Fed reduced the federal funds rate dramatically over the course of 2001 and kept it low through 2004 before starting to raise it. But even in 2001, house prices, as measured by the Federal Housing Finance Agency's House Price Index, were already rising and had been rising for several years at rates between 6 and 7% per year. So there was already a lot of momentum in the market before the Fed got going. The second thing is that even though the federal funds rate, which again is shown in red here, fell dramatically, the mortgage rates that count for buyers, what is it actually going to cost them to buy a house and finance it, those fell a lot less. So the 30-year fixed rate mortgage fell from a range of maybe 7 to 8% down to about 6%. And the one-year ARM fell more, but still was up in the 4% range roughly, even at the bottom. So one can do a little exercise where you ask, well, what if the funds rate instead had, say, never gone below 3%, got down to 1, so never gone below 3, which is roughly what the Taylor Rule would say would have been appropriate for the United States. How much higher would those mortgage rates have been? Well, a standard rule of thumb is that raising the funds rate by 100 basis points and leaving it there for a while increases long-term interest rates by somewhere between 1/4 percentage point and 1/3 of a percentage point. So if we're talking about 200 basis points, which is double that rule, we're talking about mortgage rates that would have been 1/2 percentage point to 2/3 of a percentage point higher than they were. So from the Fed's modeling perspective, when they run those changes to their models, yes, they see that house prices would have been damped a little bit, but it wouldn't have prevented anything like the large amount of appreciation that actually occurred. So whether one buys the Fed's arguments or not about its role in boosting house prices, the fact remains that any attempt to lean against house prices involves very difficult trade-offs. And the decisions that a central bank should make are really not easy at all. And I'd like to illustrate that by going back to the June 2003 FOMC meeting, which was the meeting at which the final cut in the funds rate was taken that brought the funds rate down to 1%. I was at that meeting. I presented the Fed staff's economic outlook at that meeting, and I remember it very well because the outlook was really pretty gloomy. We had come out of the 2001 recession in December of that year, but from December of 2001 to that point in June, actually the unemployment rate had continued to rise. There had been no recovery at all in the unemployment rate. And so the labor market was weak, and the outlook for the economy was not very good. And in addition, inflation was way below the Fed's target. So I've tried to indicate that with the arrow here. The Fed's target at that point was only an implicit target at about 2%, and the inflation rate that they looked at the most was down at about 1.5%, according to this chart, and going lower. In fact, the real-time data that we had to look at that point, not the revised 8-year later data, showed the inflation rate on this measure below 1% and heading down even more rapidly than shown here. So the Fed staff was predicting that there was a 40% chance at that point that the U.S. would actually experience deflation at some point in 2004 or 2005. Not just low inflation, but prices falling a la Japan. So with that mindset and that forecast, the question that the Fed policymakers faced was, do we want to lean against the possibility of an emerging asset problem in the housing market, given that it would take us further away from the goals that are our prime goals under our mandate, and they chose not to do it. So there's always a trade-off between trying to do something about leaning against asset prices and having to deviate away from your prime goals in the near term. That makes these very hard decisions. So what are the lessons that the Fed thinks it's learned? The first is that it can't count on a policy easing after a bubble bursts to prevent financial instability. Now, perhaps I should have known that in 2007 rather than only learning it after the fact, but that is an important lesson. And the implication is that threats to financial stability have to be addressed preemptively. So the Fed now views financial stability and maintaining it as an equally important goal for its actions as the traditional monetary policy objectives, whereas previously it was really viewed as a junior partner to monetary policy. Another lesson is that the Fed sees its mistakes, the mistakes that it made before the crisis, and it does feel that it made mistakes. I mean, it's quite open about that, as being mainly the inadequate oversight of the financial system and not overly loose monetary policy. And it continues to view to this day that using its supervisory and regulatory powers as they relate to banks and other financial institutions as really the first line of defense against asset bubbles. Monetary policy is just viewed as too blunt an instrument to be used except as a last resort, because it does have effects in other areas of the economy besides the one that you're trying to target. So very briefly, I think it's easy to see that the Fed really does have a much greater concern now about financial stability issues than it did before. What I'm showing here is the frequency of use in Fed governor speeches of two sets of terms. So I went back and looked at roughly the 500 speeches that Fed governors have given back to 2005. And I looked for use of two separate sets of terms. The first was either inflation or unemployment, because those are the Fed's usual concerns. The second was financial stability, or the term macroprudential. Macroprudential supervision is now the buzzword at the Fed for thinking about not only individual institutions in isolation, but all of the linkages between institutions and markets in the economy that can threaten financial stability. And the main thing that you can see is over in the second set of bars, those terms, financial stability and macroprudential, were mentioned in just barely more than 20% of the speeches that Fed governors gave in 2005 and 2006. But since 2009, it's been mentioned in fully half the speeches, and is now almost as prominent as the use of inflation and unemployment as terms in those speeches. So I think there really has been an elevation in the Fed's view about the importance of financial stability. And their game plan for trying to enhance financial stability very quickly, I think, has three separate arms. The first is to try to reduce the vulnerabilities at large financial institutions. So one way they're doing that, which is often in the news, are the stress tests that they run of banks. They completed one earlier this year. They're pushing for much higher capital requirements. And the Fed now, under Dodd-Frank, has responsibility for institutions that are systemically important, judged to be systemically important, even if they're banks. And so the Fed is bringing into its umbrella a lot of the institutions that really didn't have much regulation at all, AIG being an example before the financial crisis. The second is that the Fed, as I mentioned, has this macroprudential focus now where they're looking at the soundness of the entire financial system. And the third is that they are really much more closely monitoring asset markets, a variety of markets, bond markets, stock market, housing markets, et cetera, and the use of leverage throughout the economy. They've really beefed up their resources for monitoring what's going on in housing and mortgage markets. I would say the Fed is very deep into big data at this point as it comes to monitoring. Zillow is a provider of some of that data. But the Fed pretty much now has information about every house and every mortgage loan in the United States. And I can tell you before the crisis, we had very, very little microdata, and it was a problem because it made it harder to see what was really going on. So now let me just sum up. And this slide is different than the slide that's in your packet, so I'd ask you to focus your attention on the screen for the summation. The Fed views that its main mistake before the crisis was really lax supervision. It wasn't that monetary policy was inordinately loose. It now sees a major responsibility for maintaining financial stability as a result of having seen what lax supervision and regulation did. But there's a separation of policy tools that in its attempt to hit its various goals. I believe that the Fed's going to continue to use monetary policy, that is setting the federal funds rate, the QE program that's ongoing, to influence growth and inflation. Whereas they're going to use supervision and regulation, capital requirements, acting against adverse trends at individual institutions to maintain financial stability, because monetary policy is just seen as overly blunt for that purpose. And so the implication is that I don't think the Fed will use the funds rate to lean against possible bubbles in house prices or other assets, except in very, very rare cases. Thank you.